Our host for that session is Adam Shapiro with the Claros Group. Adam, are you on?
I am here. Welcome, everyone. Let me introduce our panelists here, who I'm starting to see appear. It's Eric Sprink is CEO of Coastal Community Bank, which has, as we'll talk about later, been sort of getting very active in the fintech world to great effect recently. Mary Dent is the founder of DCIQ, an advisory firm, is on various boards, including Aspiration, I notice, which is a customer of Eric's, so everyone's related there. Ryan Falvey is the founder and managing partner of Financial Venture Studios, and is so someone I know well as not only a good investor but a sort of serious thinker in the space. So delighted to have three such great panelists here. I'm just going to give a very brief introduction about what we're talking about, because sort of banking as a service and embedded finance are things that can mean different things to different people. So when we talk about banking as a service today, what we're really talking about is the provision of banking services that allow non-banks to embed banking products and services and functionality into their own products and services. Within that embedded finance, what we're really talking about there is sort of banking as a service is historically the lead customers have been fintechs that have effectively been using the components to build their own products. With embedded finance, it's much more a case that sort of non-financial services companies can embed financial services products into their platforms, whether that's to make money as an auxiliary service by cross-selling, whether that's to enhance the customer experience, whether it's to make a platform more sticky. What we're not talking about, because it would be a whole separate panel by itself, is what I sometimes call the whose data is it anyway debate around sort of companies like Plaid that are providing read and sometimes write access consumer financial accounts. Brian, can we perhaps start off with you, and can you tell us, give us maybe both the bull case and the bear case for embedded finance? It's kind of, is there good reason to believe that consumers and small businesses actually want embedded financial products in sort of their non-financial platforms? And if so, where do you see the main use cases being?
Yeah, well, and thanks for that really nice intro, Adam. I appreciate it. You know, and it's a great question, and you know, I think it's a good opportunity to exhibit the great skill of an early stage venture investor and talk out of both sides of my mouth in the same kind of sentence. But I mean, I think that the bull case for embedded finance is really that we have the opportunity to create all sorts of new use cases of financial products. And if that's, you know, everything from digitization of maybe what would have been like the store credit cards that, you know, the Gap is trying to sell you at the front, you know, when you're checking out, you know, creating opportunities like that online is now much easier. Or certainly we've seen some debit cards and, you know, holding and moving money. And so this is a new way for non-financial brands to monetize their financial services. And I think there's a lot of very good thinkers and much smarter investors than me who have made some significant bets in that space. And, you know, a number of those, I think, you know, in the last couple of years, he's kind of come to market trying to bring these products there. I think there's also a broader argument of what embedded finance is. We got touched on in the last panel of really, are there new ways to rethink financial products? Is there a new type of financial product that's not, you know, as is conventionally understood, like a debit card or a credit card? Is there some way where, you know, privacy is doing this, where they've started out with a way of essentially making it, you know, giving you more privacy in online shopping by embedding a virtual credit card into that transaction, so your credit card number wasn't floating around. They've now turned it into a product and allow lots of different players to roll out, you know, virtual cards. But that was a new way of thinking around virtual cards. That wasn't a use case that existed before, and I think created a very new type of shopping experience for consumers. And so those are almost kind of impossible to kind of, enumerate all the different ways someone could rethink financial services. I personally am a really big fan of that second use case, because I think it really creates new ways of thinking around, especially consumer and small business financial products. Like, it just opens up a whole number of opportunities and ways the market can evolve. I'm a little more skeptical of the, creating the store credit card of the 21st century, or like, the DoorDash debit card. Simply because there's only so many different payment options that a consumer wants. There aren't that many that a consumer, that they're really going to sign up for. It becomes very difficult to differentiate, and oftentimes those products end up being, inferior to just pure plays. And so I think, if you look at the offline world, there's a couple examples of those payment mechanisms that really took off, but for the most part, they ended up being, less than ideal for many consumers, and not really used that much either.
So what you're sort of saying is that people just need to be really thoughtful about where there's actual real synergy between what they're doing and the financial service that they might embed.
And real innovation. I mean, there's certainly synergy. I mean, you can make a couple points in the transaction, perhaps, but is that going to be a durable thing? Is that going to be a long-term business? And that I'm more skeptical.
That's a great intro, Mary. When you were CEO of Green Dot Bank, Green Dot was almost sort of ahead of the curve on this. Sort of, you did sort of deals with people like Uber. Curious what you learned about what it takes to make a sort of win-win deal happen in this space, and sort of what does that tell us about how we might expect the market to evolve, or maybe how we might expect it not to evolve?
I think the first thing I saw really picks up on what you and Ryan said, which is different companies have different reasons and levels of sophistication for getting into this stuff. And so they want very different things from a bank partner. Green Dot was relatively unique in the space. One, because as you said, it was a first mover, and two, because it was willing to do anything from a very limited white label behind the scenes, completely invisible deployment to a deployment where, it handled everything. And it would work with each partner to sort of figure out, what they wanted and what they wanted to hand off. And so Apple wanted Apple Pay Cash to be, part of the Apple experience, really feel like an Apple part of the texting experience, not something that would stand out. Walmart wanted to hand over the Walmart Money Card and have Green Dot handle everything from soup to nuts. Stash wanted a product that it could put next to its investment product and provide sort of a parallel product for consumers. And Uber wanted its drivers to have something that made them want to drive for Uber and turn off any other app that they were driving for, or at least, pick an Uber ride first. And so I think that was one thing was, as your introduction said, we tend to talk about this as though it's one thing. It's actually a lot of things simultaneously going on. And as Ryan said, really not clear yet which of these are going to work and which of these are going to be, I don't know, been there, done that, and they'll disappear in a few years because they're just not that interesting or innovative. I think what it means in terms of looking forward, one is there is a most people getting into this care about the consumer, not necessarily because they're any better, but because the only way you can acquire consumers is to offer them something that they like. And I think there is a huge overlap between a lot of bank regulation, which a lot of it is consumer protection, and what a company that cares about its reputation and cares about the consumer experience naturally gravitate towards. So I think that partners who care about those things tend to be really good partners for banks because they're going to self-select for behaviors that actually make compliance a lot easier than somebody who's, a little bit more cavalier. And I think that sort of settling out of consumer financial services in particular, but to some extent all financial services, you have to have a really high bar for the integrity of what you do. you can't make a lot of mistakes. And so I think there's probably going to be some settling out between the people who aren't really ready for prime time, and that's why they're going with a bank partner and probably don't deserve to be in financial services, versus people who don't choose to be a bank, but are serious players. I think the big thing that's going to have to play out for the banks is, and it'll be interesting, maybe Eric can talk to this, are they a dumb pipe, a vendor with all of the negative stuff that implies over time about margins and negotiating leverage, or are they a value-added partner? And I think banks are still figuring out how to position themselves as value-added partners, but that's going to be hugely important to how the industry plays out. And the third is probably second area would be technology. What do people want? What will stable, growing people want? Do they want just tech? Do they want tech plus bank? Do they want it all wrapped up in one? Will they go to multiple partners? And then I think on the regulatory front, this whole area is moving so much faster than the regulators. And I think there's probably going to be some things that blow up because the regulatory structure of supervising banks just isn't well matched to relatively small institutions managing all the innovation that's happening in this whole area.
Let's maybe come back to that later, because I think that's really interesting. But I'm sort of, there may be some people out there that are sort of wondering, well, how hard can it be to sort of embed a service that moves money from one place to another, or sort of makes a loan to a consumer into sort of something else? And, you were talking about sort of the people that wanted Green Dot to do everything when you were there. It's kind of, what are the things that might sort of surprise people about sort of what you need to actually do this and to sort of make it look effortless and to sort of create that sort of experience that people like Apple want? I was always struck, for example, by the modern Treasury CEO's blog post about the difference between the ACH return code meaning our customer is dead and the one meaning that the guardian of our customer is dead. What sorts of things did you have to block and tackle at Green Dot for the people that wanted you to do everything?
Well, first, it is a huge logistical process that involves a lot of players. So you've got to get cards in people's hands quickly. You've got to make sure they're going to the right consumer, not a fraudulent consumer. You've got to be integrated with platforms that in fractions of a second can authorize a transaction and then correctly sort of move it through the system. And at the point of sale is, also looking for fraud. I mean, just fraud itself, when you think about, I have zero tolerance for fraudulent charges on my card and zero tolerance for having transactions declined, especially if I'm a low-income consumer who doesn't have a second card in my wallet that I can pull out when the first one doesn't go through. So you've got this massive technology integration that has to happen with perfection in nanoseconds 100% of the time. You've got fraudsters always trying to break it. And then you've got a really complex array of rights and responsibilities. So, if you've got people calling into a call center, you've got to be able to tell the difference between they're unhappy with something and a protected transaction that under federal law, you've got to hear them saying, I didn't authorize this. And then you've got 10 days to investigate it, give them their money back, or, document that you figured out that they're lying to you and it really was an authorized transaction. I mean, so there are so many layers to making it work, and so much interest on the part of the consumer, on the part of the regulators, and on the part of whoever owns the brand of making sure it works always when it's supposed to and never when it's a fraudster trying to sneak into the system.
And I think it's such a fascinating question about sort of the value stack in this business, all the things that need to be done and who can do them best and capture the value. So maybe we let's turn to Eric and talk about the banking aspect of that. Eric, Coastal's actually made a really impressive, I think, entrance into the sort of the banking as a service business in recent years, as well as Aspiration, who you mentioned, clients like Elvest and One Financial, and I know sort of several mutual customers who've got some impressive other people in the pipeline. Tell us a little bit about why you thought this was an attractive business to get into, and what have you learned about what it takes to do it well?
Well, thanks, Adam, and appreciate Howard inviting Coastal to be on this panel. And humbly, I need to announce too, I've sought Mary's advice and counsel, and she has consulted with us. Adam, I've asked his counsel and support. The only one I haven't begged for advice from is Ryan, but you're next, my friend. Right, we've been in it 5 years, but I feel like really the newbie on the block. So about 5 years ago, we stumbled into this partner banking, and my board we're eternally trying to figure out, as a community bank amongst giants and in fast-moving technology sphere of Microsoft and Amazon that reside all around us, how can we evolve and keep up? And we really looked at our bank and said, what are some of our strengths? And at the end of the day, it came back to, we're really good at operations, we're really good at compliance, and we have a piece of paper that says we can move other people's money. And I adore Mary, and she is right. We started with dumb pipes, and we said, hey, they're dumb, but they work. And the board kind of had an analogy in 2010, during the last Great Recession. Our communities were under a tremendous amount of stress because of credit quality in the banking space. And we were tiny. We were about 150 million in assets, and literally we weren't in trouble. So all we had to do was keep our doors to our branches open, and business was flooding to us because the other banks were trying to shrink and get out of their exposures. And literally it was nothing magical other than keep your doors open. Well, the same analogy applied to, hey, we've got a charter, we have these pipes, they're pretty dumb, just open them up and let people use them. Well, what we've learned in 5 years is, one, that's very difficult, and I'm more than happy to share the landmines that we've stepped on and all of the lessons, but really the infrastructure build you have to do, but also the debate about dumb pipes and is that enough? And I think we've taken a lot of progress towards that, and we can add our 2 cents about embedded finance and pros and cons and what it means for Coastal, at least from our perspective as the bank. But to how to manage this, it really, at the end of the day, we've transformed ourselves into a data management company. And yes, we have branches. Yes, we have lenders, and yes, we have partners, and yes, we have strategic venture with Google through the Googleplex that was announced this year. But really, those are just front ends that bring us data into a management center. And so really we had to build that infrastructure, and selflessly, we're going to talk about one of our investments later, Neokova, is helping us build that data center to manage data. And that's for fraud, as Mary talked about, at the light speed of the API expectations today, the customer experience. I don't own that customer. It's my fintech partners, and I'm representing them, right? So we have to perform at a high level of execution so they look good. And they deliver a seamless experience to their customers. And that takes a lot of work on our side, but it's still the foundation of operations, compliance, oversight, and that's banking, right? We are safe by nature. Now, what you're seeing in evolution of this tech fin companies is smart people coming into the business saying, yes, you're safe, but we can do it better, faster, and remove more barriers and allowing new people to get in. And that's the nice marriage that we're coming to. And I think it's matured enough now that the ecosystem is embracing both smart and safe. And I think Mary nailed it again. I should just ditto everything she said, but regulators are getting up to speed on this too. And they're trying to run as fast as they can. And then just on the other side of the equation of how do we stay relevant in banking as a whole, the board just said, man, if we could really work with these fintech companies and we could learn from them, then maybe we could apply that to Coastal. And right, let's use proverbially VC money via our partners to learn how to market, to learn how to onboard, to learn how to do fraud prevention, to learn how to do BSA management, to learn how to operationally move the money as fast as we can, as safe as we can. And then we can apply that to our own digital bank. And so that was our goal all along, was to evolve Coastal via really a process of learning via partner banking. And that's, I think, that third evolution, or our third division you're seeing, is now us venturing into the Googleplex relationship, which is really a vendor relationship of ours. But it's really our own fintech. But this time we own the customer. And this time we're trying to cross-sell and talk to them via a partner. But hopefully that answers your question.
No, that's a great answer. So I'm curious. I mean, you've done a ton of work working with sort of Neocova, Synctera, and others to make your pipe smarter. At the same time, we've seen a rise of, if you like, non-bank platforms that have come along and say, hey, the banks are no good at this. We'll be the middleware layer. We'll manage the data. We'll do that. We'll just let the banks do the compliance and pipes that they're good at. So, you know, it's sort of, you've got companies like Synapse, Treasury Prime, Unit, Bond, sort of, you see Stripe Treasury coming in as, if you like, the 500-pound gorilla in the room. It's kind of, how do you think of those platforms' roles? Do you think there's a place for that? And it's kind of, as you look at the ecosystem, do you feel they're your friends and potential customers, or are you competing with them?
Yes. I mean, how's that for talking out of both sides of the mouth? So one, you're right to say that we are trying to improve our own capacity to meet client needs or our partners' needs. And so what we found out, you know, going into year 3 or 4, was not all fintechs are completely built technology stacks, and they need help, and they needed more help than what Coastal could provide them. And really, what we found ourselves was only being able to help about, 30 to 50% of the technology or fintech market. And we said, we really need to augment our dumb pipes with some partners. And even with Synctera or Nimbus or Bond or those Treasury Prime, et cetera, they're great. Really, they're leveraging still the bank's dumb pipes. And so it's still a good relationship for us. And as long as we can still have oversight of compliance, operational integrity, and manage the data, not to say who owns the data, but to manage the data and have oversight of the data. Don't want to pick that scab, but right, it's around the thought of, I think the partnerships are beautiful. And I think the supply and demand is so out of whack. These middleware companies like Synctera, who we are an investor in and are working on, the real goal of these companies, and I know Chris Dean at Treasury Prime, he's fantastic, and the guys at Nimbus, Jeffrey Kendall, they are trying to enable my peer banks to do what I do. So I'm not worried about the middleware companies. I think they're beautiful in that they're enabling more community banks the option to get into this business while de-risking it for them. Now, at the end of the day, I know Mary kind of alluded to it, there's an inverted pyramid risk curve on getting these small community banks into this partner banking. But I do think these middleware companies pose some of that gap of helping them to bridge that compliance, operational integrity, and data management. And I think that's needed. And I do think more banks need to get into banking as a service, because I'm not all sure fintechs, want to become banks, all of them. Adam, you advise so many fintechs about do or do not, and you see it much more than I do, but right, they're all dwelling with this. But I still think a majority are going to say, hey, I'll work with a bank. And if I'm very sophisticated, I'll go straight to Coastal. If I'm not that sophisticated, I'll go through a middleware platform to get to Coastal.
Yeah, no, I mean, I think we end up telling 85% of the people that come to us about being a bank that we think they're crazy for one reason or another, or often multiple reasons. So I absolutely agree with that. You should be careful what you wish for in
Yes.
sort of taking a high growth business into the banking regulators. Ryan, I'm wondering how the participants in the ecosystem look to you. It's kind of you've got the banks, you've got the platforms we were just talking about with Eric. You've got the sort of the fintechs that are building on it, the non-bank players. It's who are the winners and losers here in this new world? It's kind of invite you to sort of gaze into your crystal ball and sort of give us a sense of who you think is well positioned.
Yeah, that's well, the losers are the big banks because none of them are on this call. But no, I think that they're probably honestly long term, I think have made a massive strategic blunder in how they viewed fintech and how they position themselves in enabling the ecosystem. They basically just played by the same playbook that they always did, which is like, you know, money's not evenly distributed. Let's go for where most of the big money is and serve that piece of it. And in turn, I think have effectively seeded almost this entire market over the last 10 years to, you know, small banks that are willing to learn about it and get involved and are all of a sudden punching pretty far above their weight. And there's some regulatory advantages they have. But I think those are honestly, I think they're pretty de minimis at this point. So I think that I think from the winners are, you know, banks like Coastal, you know, Blue Ridge Bank does a lot, Sunrise. We can go down the list of a lot of, you know, relatively small banks that have started to play a really pivotal role in the ecosystem. And I think Eric is dead on. You know, for the institutions that are, for the fintech companies that are really sophisticated and can understand how to both technically work with a bank because they are, I mean, they're on a completely different technological plane than most startup employees are. And so you need to know how to kind of interface there, but then also to deal with all the nuts and bolts. I think it was Mary had a really great point of it. You know, there's so many layers. I mean, there's so many things that I think a fintech startup doesn't think about. Like, what does a mailer look like when you send someone a card? Because if it just looks like a random piece of white paper that has some totally random company's name on it, the half people aren't going to open it, throw it in the garbage. And then all that work you did to acquire a customer, you can open an account, issue a card, is not being spent on it. Or someone calls up and what does that call center say to the person? What does that customer service experience look like? I think that, you know, there aren't a lot of fintech startups that actually have that sophistication early on to do that. And so I do think a lot of these, you know, these middleware players play a very important role in helping to kind of bridge the gap between idea and directly working with a Coastal or another bank that can do that.
How much do you think for the middleware layers this is going to end up as something approaching a sort of winner takes all market? It's kind of, is there going to be sort of the equivalent of a Stripe in online payments that, or do you see sort of room for multiple players here?
So there's this analogy of, you know, the AWS of fintech we're looking for. AWS is made by Amazon, which was like a multi-billion-dollar public company when they started selling AWS. And so I do think it's much more likely that the AWS of fintech is a large institution that has the resources to simultaneously send a customer to multiple banks, know exactly where that data is, know exactly what the right partner looks like, can kind of manage that whole stream, can build product really quickly and efficiently. I mean, I think we're in a very different landscape now than we were even 18 months ago, with Plaid still being an independent company, with this incredible traction Stripe has had in developing new product. I think those guys have, both those companies have a lot of room to run ahead of them. And so I think clearly both of those firms are going to be winners. And so I do think that when we look at the banking as a service ecosystem, they're going to have to become more specialized, and they already are. And I mean, we've mentioned a number of phenomenal companies, and I think if we went through each of those and listed like what they do, I think we could there's enough differentiation, even with the 5 or 6 that you mentioned, that those could still be very large businesses. But the idea that there's going to be one entity that kind of solves it for everything. I think that either is it's going to be a huge global firm like a Stripe, or it's going to be a number of really big ones. And banking is a very specialized industry, and you actually get a lot of benefit by knowing a market really, really well. I don't think there's nothing about the rise of fintech that seems to have disrupted that in any way. I mean, if you look at the companies that have been successful, they've been very, very focused on a demographic or a use case and just doubling down and building into that niche as it grows. And I think that the supermarket model is probably less likely here than in web hosting, but I think the bigger players are certainly
One more follow-up before I invite Mary to pour a large amount of ice water over the whole thing. Do you think that if you're looking at sort of companies like Treasury Prime, who of course Chris was on the API panel earlier, for sort of people that have been here all day, and well done for sticking it out across time zones if you have. It's kind of, do you think that companies such as Treasury Prime are going to have to choose fundamentally, do they want to serve sort of fintech customers that want one type of implementation, or embedded finance customers that want another type of implementation, or do you think it's possible to go after both markets at the same time?
I mean, so I don't have any special insight into Treasury Prime. I mean, they're a very well regarded company. I mean,
just companies like that.
Yeah, I mean,
pick
I
Synapse
think
or Bond or whoever you want.
I think the U.S. banking market is so vast and large that you can, and I think that the idea that this is all like a pie and we're just taking slices of it is not the right analogy. To me, it's more like a balloon. And it's like we got a little dot on the balloon. It's deflated. As the balloon inflates, the dot gets bigger and bigger and bigger. And I think that for the Treasury Primes or any company in fintech, that's one of the benefits of not being a regulated entity. So I'll kind of tee up the ice bucket that Mary will throw in it. But one of the benefits of not being a regulated entity is you can grow super fast. And so I think that I'm sure Treasury Prime, if they found how to solve that thing, I mean, there's probably one thing where they're getting a lot of demand for. And I mean, the playbook is just to pile into that. And eventually it gets to be pretty big. I mean, I don't think anyone would have thought that making it easy to access 6 or 7 banks in this country would be the groundwork of a multi-billion-dollar data access business, or that making it slightly easier to accept credit cards on the internet would be a $100 billion business. I mean, some of these things just you got so much tailwinds, I think, in just this fundamental shift in the market, that I do think that all these businesses.
I think it's going to be fascinating to watch whether this market effectively polarizes into sort of people that are supporting the people that just want to please do everything for us and just give us something we can put into our experience, and the people that sort of want to do as sort of much as possible, the fintechs. Mary, what could go wrong here? It's kind of, what are the downside scenarios that sort of policymakers and firms alike should be thinking about now, so that we don't sort of slip on the banana skin down the road?
Well, the first, I'll touch on 4. The first, I'll say, I don't actually worry as much about consumer protection, because again, I think the whole point is, if you want consumers to come over, you have to give them a better experience than they're getting someplace else. So I think people are really worried about consumer protection, and that's not what I'm worried about. The 4 things I would say is, 1, what I call the upside down pyramid of Durbin. There's a law that lets you get a better financial return for processing transactions through a small bank than a big bank. And I won't bore you with the history, but what it means is a lot of these partners, including really large partners, are choosing to partner with very small banks. And those banks have capital that's typically tied to their lending book or their total assets, not so much the transaction volume that they process. And I think that's something where regulation needs to catch up to say, what's the true risk profile of this institution? Therefore, how much capital does it have to have, so that when something goes bump, it doesn't fail. It gets through it. It may be ugly, but it gets through it. So that's the first, is that you've got institutions that are more fragile than they should be, serving as the front end into the payment system. and the banking system for all this activity. The second is, there was a panel earlier that talked about Wirecard and how hard it was that they tried to regulate the Wirecard bank, but because they didn't fully understand what Wirecard was doing, they couldn't do that. Ryan was just talking about all the reason people don't want to be banks. So the regulators are struggling with how to license new banks. And so even those who want to be licensed, by and large, can't be. They're not ready to be, or they'll never ready to be, or they don't want to be because they don't want to take on the burdens of being a bank, or the restrictions on what they can do that come when you sign up to be a bank holding company. So that means, by and large, an increasing amount of activity is happening outside of the regulated industry. 10 years ago, we went through a financial crisis that, one of the big drivers was there's all this shadow banking. Well, that's exactly what we're doing it now. We're just doing it in all kinds of new places. That was, a lot of that was about shadow banking in lending. Now it's transaction, consumer accounts, transaction processing, all this stuff is happening outside of the main banks. And so the regulators are looking to relatively small institutions like Eric's to solve the problem that they don't know how to solve, which is how should we be regulating these people? And because they won't decide how to do it and regulate them directly, they're hoping that the Erics of the world have this. And I would say that is a pretty heavy burden to put on the community banks of the United States. So that's the second, is you just have people who make mistakes, and instead of catching them in advance the way the regulators are supposed to, it waits till it blows up. And I'll talk about the third and fourth are really two specific examples of this. And it gets back to what Ryan said, which is some people don't necessarily understand the full implications of what they're doing. So most people understand the core risks of whatever their business is. But so if I'm doing consumer accounts, I probably understand the core of what I'm doing. If I'm doing consumer lending, I probably understand the core of that. But if you start doing it at massive scale, then you've probably got liquidity risk, because money shows up on different days and it goes out. And if you have a mismatch between those, that's when, Bear Stearns collapsed over liquidity risk. So you get liquidity risk wrong, sort of when is the money coming in, when does it have to go out? Or you get credit risk. There's credit risk associated with those, those gaps, which is if Ryan's supposed to settle with me in 2 days, I actually had 2 days worth of liquidity risk to Ryan. And if his company, is doing $2 trillion of payments, that's a whole lot of credit risk that I better understand how he's good for it, because I don't want him to go bankrupt between today and when he's supposed to give me the money on Thursday, no matter how much it seems like it's just a machine that runs. I don't know if anybody remembers auction rate securities, but the auctions always worked until the day they didn't. So that's a third one. Do people fully understand some of the risks that they're taking on? And the fourth is just generally the whole topic of operational risk. Eric and I actually met, there was a Fed panel to talk about how should we be dealing with operational risk. It is not in the historical sort of bank supervisory playbook. They focus a lot on money laundering. They focus a lot on credit, liquidity, interest rate risk, but operational risk is not part of their handbook, and it is not something they've got a sophisticated way of dealing with it. So you've got massive operational risk in a system that is made up of tying an increasingly large number of divergent players together in a faster and faster paced environment as we move to real-time payments.
Yeah, and I think it
really understands that whole thing. So those would be the four I'd say.
Yeah, and I think there are some really good things there, and it's amazing how many basic things people can get wrong in this area, right? It's just the simple thing, like you've got a pooled account and you've got the program manager that sort of knows whose money it is, and the number of banks that sort of, if something went wrong, it's questionable whether they've got up-to-date data on that. I give Eric a lot of credit because he and Coastal have been very thoughtful on how to manage for that risk, but it's kind of, I think it speaks to your point, Mary, that sort of we do need a new regulatory playbook if we're going to avoid a crisis and sort of give this the potential it deserves. I think we're coming to the end of time here. I'm hoping that I'm not seeing anything on the chat, but I'm just maybe going to invite everyone to just sort of give a couple of sort of thoughts about sort of what is Bonnie Doon 2026 going to be talking about in this area? What get that crystal ball back out and just give us a couple of sentences about how this is going to evolve.
I can go. Mine would be, it goes back to what Ryan said at the beginning. Is there any real innovation happening, or is this people making massive amounts of money by improving a little bit the use cases that we have today? Or is there anything really new happening in consumer or commercial finance?
Eric?
You know, I 2026 is going to be here before you know it, and I don't see any draconian changes other than just new entrants. I think the acceleration of non-financial entrants, like Walgreens was announced yesterday, getting into that. We all know the big tech companies are getting into it. I just this brand affiliation. I think in 2026 there won't be a bank that doesn't affiliate somehow with somebody that has a customer base that's loyal to them, and the two try to co-brand and co-market and just tie those two a little bit better. And then I think the regulators are coming along fast. We have the privilege, and I say that carefully, but we get examined every 90 days. We're a Federal Reserve Bank, as Mary mentioned. So I get to see my friends every 90 days, and they're here, and I get the write-up 30 days later, and they're here 2 months later. They're learning, they're growing, and I say it's a privilege because we're building with them, and I feel very fortunate that they spend so much time with us. And you almost have to have that mindset of they're a partner in this evolution. So I think 5 years from now, we're going to see a whole new evolutionary regulatory scheme that doesn't exist today. And I think it'll be for the better, because there will be standards, there will be processes that banks can lean on and the fintechs can lean on, and it doesn't expose the parties to gotchas.
Ryan?
Well, I'm about to introduce two of my companies to the next session. So I'll just to self promote. We'll probably be talking about the IPOs of Fairplay and Daylight in 6 years, because they'll just be so valuable and so successful. But I do think that that we are going to be dealing with a completely different, especially on the consumer side, financial services landscape. I mean, if you see the growth that's happening, you look at Square's level, Cash App. I mean, with tens of millions of customers, are still growing at rates that you'd expect to see an early stage startup growing. And within our own portfolio, you're really seeing this massive shift of consumer behavior to a lot of these fintech apps. It's seeming, the pandemic certainly accelerated it. I can't imagine it going back. The growth might moderate a little bit, but I do think we're going to end up in several years. I think, to both Eric and Mary's point, the regulators are going to have to get a lot more sophisticated, because we're going to have a couple 100 million people using fintech apps as their primary bank. And I think that's going to represent a very different financial services ecosystem.
So I'll just offer one more to conclude here. I think the story in 2026 is going to be about how financial services in general and banking in particular has now become much more integrated into everything that consumers and small businesses do. It sits as a moat at the moment. And the really interesting question here is what's going to cause that? Is it going to be caused by embedded finance? Is it going to be caused by sort of better data access? Is it going to be caused by the direct-to-consumer and small business banks getting their act together about how to integrate safely with non-banking products and services their customers use? And so it's kind of, I think the vehicle by which that happens, it will happen one way and another, is going to tell us a lot about who the winners are. And with that, let me, Howard, send it back to you.
Terrific. Thanks so much, Adam, for being a terrific moderator, and for the group. You all Ryan, Mary, and Eric for your insightful comments. I sure learned a lot. I feel like this is one of them that I'm going to listen to again. And we're going to have to move on to our next block, which is startup time again. We have 4 more startups to have the pleasure of listening to this afternoon.